There's a saying in my head, a good trader can identify the trend. A great trader knows how to identify the trend, but the best traders I've seen know how to read the story of the market and read the trend in real time. So let's dive in. So this is US30 on the 15-minute time frame, and I'm just going to be going over and breaking down what I call the four-pillar approach. So the four-pillar approach is a very simple sort of framework that I use that just allows me to identify my daily bias. So before the New York or the US session even begins, or if you're in the London session, you want to have a way of having an exact framework which tells you the daily bias. And so this is how I find my daily bias. So what we can see here is we see structural markings of highs and lows and highs and lows. So on Dow Jones, my most recent structural dealing range high is here, and then of course we've had the breakdown here. So for Dow Jones, this is my structural low and this is my structural high. So this is the four-step framework that I use. So the first thing is market structure, right? So market structure is just about identifying the most recent high and the most recent low. And so by identifying this, we have step two. Now, step two is the dealing range. Now, the dealing range is the most recent high to the most recent low. And so if you're a struggling trader with daily bias, I want you to take a few minutes out of your day, maybe 5 to 10 minutes, just to refine your structure. Because truthfully, structure is not difficult, right? I don't think market structure is difficult, right? We have a structural high, structural low, structural high. And so all you want to get used to, in my opinion, as a trader is just marking out these arrows, because these arrows that represent market structure is like a vehicle to the market. And having that vehicle will allow you to derive your daily bias, in my opinion, with a lot more certainty. So you have a structural high, structural low, structural high, and then we had a breakdown here. Okay. Then we had this low take out the previous high. So we had a break up here as well. And then of course, this high took out this previous low. So we have a dealing range now. So for Dow Jones or US30, my dealing range high is 49.60.692, and then my dealing range low is 48.309. So this is my current dealing range. Now, once you have your dealing range, and this is where the daily bias comes in. So if we just take a look, we've had this huge dump. So kind of Monday and then Tuesday, we had this huge dump coming into this week over here. I just want to break down this move over here because I think there's a lot of things traders can take away. So coming into Tuesday, the 27th, right? So Monday was pretty choppy. We chopped around this area. Coming into Tuesday, what would my bias be? So if you have a problem with daily bias, I want you to kind of approach the markets in this simple framework. So we've been through market structure. Right, that's the first thing. So we have our structure, and once you have your market structure, that gives you your dealing range. And so your dealing range gives you the most recent low to the most recent high. This is where your daily bias comes in, right? If you want to look at this dealing range carefully and you want to ask yourself, are you in the premium of that range or are you in the discount of that range? So those are the two areas that you need to be considering, and you're either going to be in one or the other. If you're at the EQ, that means you don't trade because you're at a fair price. I don't like trading at the EQ. If you get chopped out, just have a look and zoom out to see if you're at the EQ for the 15-minute dealing range. Now from here we can either have two things from the dealing range. We can either be in premium or we can be in discount, right? Now from here, it's pretty obvious that most people can see that we're above the 50%. And so we're in a premium. And so when you're in a premium, what you then look for is a fair value gap. And once you have a fair value gap, this then gives you your key level. And we're going to be going over this key level. And so a key level is basically a fair value gap plus order flow. So this is the framework that I want you to follow. So if you struggle with daily bias, you probably mess up somewhere here, or you don't even know where to start. Right, so once you have your market structure, identify the most recent high and low. So that's going to be this high to this low down here. So just make that clear, this high to this low. Now, once you've done that, you then want to focus on where are the fair value gaps in premium, and then you want to identify your fair value, your order blocks basically, or your key level. So that's kind of the order in which I wanted to start off this video, just to go over daily bias and how I predict my daily bias using the four-pillar approach. Once you have your daily bias down, the next thing I typically do is I look for my three-step model. And so my three-step model is, I call it the triple X model. And so the triple X model basically helps me identify in real time what the story of the market is. Because the market is always telling you a story based off what it's done, it's left clues, the main characters have given you signals. It's just your job to pick those up. And so the triple X model can be boiled down to three things, right? So you want to know where to trade from. This is your key level. You've got to have a key level. You then need to know what to look for, right? So this is going to be buyers and sellers. And the final thing you want to focus on is why, right? Why does the market actually go down in this case, right? So yes, we're in a premium, but we want to focus on key levels and order flow to give us a precise reason as to why the markets move down. So let's break this down. So if you're a US30 trader or, any, US American stock market trader, I want you to focus on 15-minute fair value gap. So this is the 15-minute time frame for US30. And I want to draw your attention to this 15-minute fair value gap over here. So how do I choose my fair value gaps? Because there's one here, there's one here. Now, in order for me to take a trade at a fair value gap, it needs to meet a few criteria. So for me, this is going to be my key level. Again, my key level comes from a fair value gap. So this is the key level. The fair value gap you can see is just over here. So what makes a fair value gap for me? So the first thing is I want to see some kind of liquidity being swept. So I want to see a previous day high being swept, which is what we have over here. And we have some, session highs being swept over here. So I like this. I like liquidity being swept. Now that's the first thing. The second thing is I want to see the market reacting to this area, right? So this area here, the market reacted to several times, right? So we're going to break down two areas. So what happened here? So this is now Friday the 23rd, and then again Tuesday the 27th. This is a lesson that traders should understand, because I get this question a lot. How do you derive your key levels? And so for me, a key level, right? This is a key level, and I'm going to break it down. A key level has two parts to it. It has to have a fair value gap, and there has to be some kind of proven absorption. And so the thing to understand is that you cannot trade fair value gaps unless you know where the absorption is happening. Absorption is basically the interaction between buyers and sellers and who is being trapped, right? Who is being trapped, or another word is absorbed. Who is being trapped, who is being absorbed. So by using footprint charts with fair value gaps, it gives you a much better chance of actually getting this right. So again, breaking this down again, if I look at the 15-minute chart, now from here, daily bias, let's go back to our daily bias. So what we've done is we've established a key level. So going into Tuesday the 27th, we've established some kind of a bias. So here's a key level. This is how I do my pre-market plans, right? So here's a key level 1, here's a key level 2. So break above 1, we would be bullish, break below 1, we would be bearish, and we'd want to target 2 or at least the EQ over here. That's sort of the plan. Now, that was my daily bias. So this is the first of the triple X model. So we have a key level. This is step 1, key level. Now, once you have a key level, how do you validate it, right? What do you look for inside of a key level? So this is where we're going to go down to the 5-minute chart. Now, on the 5-minute chart, we're going to be understanding, you want to understand the price action here in this region, or even the 1-minute chart, right? You want to see this sort of price action here. So what you're looking for here is a break and retest. So a break and retest is very simple. We see price giving us a break and then a retest, and then we go short. It sounds easy and it is simple, right? I don't think trading should be difficult. So this is step 2. So step 1 is we have our key level, right? That's the first thing. You've got to have step 1 in place. And I'm just going to be going over this key level on the footprint charts. So this is the ATAS platform on YM. So US30 is the same as YM. Now, this was the first melt off we had on the 23rd of January. So let's try and understand what was going on inside of this fair value gap, because this is still the fair value gap we're interested in, right? The one from the 22nd of January. We're still interested in this fair value gap. So we want to see this first initial melt off over here. So this melt off was Friday the 23rd. So on Friday the 23rd, what was going on inside this key level, right? What made this a good shorting area? So this is where the footprint charts come into play, and we want to just break this down candle by candle. So notice how we have multiple retests, so retest, retest, retest before the markets melt. So we're just going to be going through one of these retests over here. So what we can see in this in this specific area is the following, right? We break below the zone. So this candle here and these series of candles are quite interesting here, especially here up top, and then this candle over here. So we have a big break below our zone. So if we just go back to the candlesticks, let's go back to the candlesticks quickly. This is what we have. So we have this big sort of break below the zone here. So we have multiple retests. So here was one break, and then here was another break. So these breaks are not that valuable. What is valuable is you want to know what was going on here in this price action. And more importantly, the final retest, which was here. And also the price action here as well. So the theory is once you have a key level, you have to understand what's going on inside the key level. What are the main characters in that story that dictate what's going on? So it's not sweeps. It's not any of these things, right? It's not, you don't need to wait for a sweep. So if this is your high, these are equal highs. You don't have to wait for, a sweep. You don't have to do any of this. You don't have to wait for a market structure shift. You don't have to wait for any of that. You need to have confidence in your levels, inside your levels. You have to know specifically what's going on. So this is where the order flow comes into play. Now, if we look here, this candle here, let's go up top, right? This candle here is very interesting. We actually have, yes, it's a red candle, but we have aggressive buy orders that are outnumbering the aggressive sell orders. Now, we see that via the positive delta over here. So we see more aggressive buyers and sellers giving us that blue delta. Now, when we go back to the the candlesticks, we see that, here, we see that here, and we also see that here as well, and here as well. So what's going on in this entire region is we're seeing the following. We see aggressive buyers. That's the first thing. We see these aggressive buyers really trying to drive price above this level, but we break below the level, right? And we see that on the footprint charts too. Right, footprint charts give us live information about who is aggressive. Now, what's interesting here is this region over here. So we break below the zone. We have this big red candle. We break below, meaning these buyers have been rejected, right? They've been trapped. They've been absorbed. Now, what's interesting in this region, so for YM, that's going to be 49,429, around roughly this area. We see this blue delta, this positive delta as we break below. So in real time, what's really going on? Let's break this candle down. What's really gone on when we break this candle down here, right? We had this huge break to the downside. This break was accompanied by a lot of aggressive buying. So there was aggressive buying here, right? We can see that via the footprint charts. There was aggressive buying here, and there was also aggressive buying here. So we have two areas of aggressive buying. Three areas of aggressive buying. So this is what confirms that the zone is actually a valid supply zone, right? The reason we know it's a supply zone or sellers are in control is because we can see the active buy orders or the aggressive buy orders failing. And we see that throughout the level and just as we break the level. Now, taking that into consideration, let's go to Tuesday the 27th. So on Tuesday the 27th, what's important to note, because I get this question a lot, right? Here's something you want to know. If you have a proven key level off a fair value gap here, so here's the FVG, there's the proven fair value gap, right? There's the proven rejection. So we had this rejection here. So this was the 23rd of January, right? 23rd of Jan. Now, what's interesting here is when we come back to this level, right? It's still a strong level, right? This is the question I get the most. The true traders or the true market participants who really understand the market will understand where trapped players are. Where is the absorption happening? Where are those trapped players? It's one of the most important things you need to master. So once you have your key levels here, once you have your key levels, when you tap into this zone, you have to anticipate either a rejection or a reversal. So what makes a fair value gap valid isn't the fact that it's just there. What makes it valid is the fact that we already have proven evidence that the zone was active with sellers, because here there were passive sellers, right? And passive sellers are what drives price down. So we know it's a proven supply. So when we go over here, when we come into Tuesday, either we can, see a break higher, or we can see a break lower. But the point I'm trying to make is that this is an A plus level, or it's an A plus area to trade, because there's already been an absorption there. So this is something you have to practice. You have to practice finding the right fair value gaps. You have to then practice the absorption at those fair value gaps. You then have to practice dragging your zones to the right, and you have to practice patience to wait and trust in those levels. And this plays out over and over and over again. Now again, a simple repeat again of what happened at this level here. So again, we had break and retest. Again, a bit of a quick break and retest, but break and retest nevertheless. So the way that I use break and retest is kind of like this. So I want to see price break, and then I'm looking for some kind of retest here. So for me, that's good enough for a retest right there. Right now, if you want to be a little bit more conservative, you can. So I don't trade US30 or Dow Jones or YM, but again, having your entry here after the break, notice how it's happening after the break. So what's happening here is we have a break, right? Then we have some kind of retest, and then we go short after the break has been complete. And so what's going on here, I would have my stops, slightly above here. So what's going on here from a candlestick perspective is, or just from a chart perspective, just like I said at the start of the video, right? If we go to the 15M, on the 15M, what we have is premium, right? This is premium because we're above the 50%, right? And we're simply targeting discount, and we're targeting this key level here. This is also a key level for similar reasons of absorption. So the reason it's an A plus trade, in my opinion, is because we've stacked multiple confluences. So we have a key level off a fair value gap, we're in premium, we see absorption, we have an area to target. That's it. So we're taking all of our concepts and we're stacking them together, right? That's the sign of a mature trader. When you can stack confluences together, that's the sign of a winning trade, right? So this trade didn't run all the way, I don't think, but I think it definitely did have some decent runway, I think. There we go. Oh, I think it did. So there you have it, right? So there's your US30, there's your US30 trade, right? There's your US30 trade. I just want to see if it played out. Yes, it did. So what we're doing again, once you have a good read on levels, right? You have a, key level 1, key level 2. Again, knowing where these levels are and knowing what happens inside the levels is the most important thing, and that's what's going to catch you the trade, because these trades look like they come everywhere, but if you get reversed or you get faked out or you get stopped out or you're not sure where to pull the trigger, strip things back. Are you in premium? Are you in discount? How have you found your levels? And most importantly, is there an absorption at those areas, right? This is what you need to pay attention to, in my opinion, right? So that's sort of Dow Jones. The only other thing I wanted to cover also is volume. So I just wanted to finish off with volume. Now, if we just take a look at, volume profiles, this key level here is situated near these POC areas. So POC, either we're trading, we want to be trading in these high volume areas, right? So you can see here the market from Sunday or Friday tapped into the POC, again tapped into the POC, again this was the POC, and we're targeting also down here at POC. So volume profiles I don't use as much. I prefer to use fair value gaps and absorption, but just having an understanding of where the volume was high gives you an indication for reversals. So just to sum up this video, going, what we've been through, right? The stuff we've been through mainly is, the concept of choosing a fair value gap based off market structure. So highs and lows, we're in premium, we have an absorption at this fair value gap. And so the main thing I want traders to kind of take away is, once you have a proven absorption here via these footprint charts, right? Because we've seen the absorption. Here we have a, pretty big absorption, right? Even over here, if we just keep going over here we had another pretty large absorption on the 5-minute chart, right? So what we can see here again, we see the aggressive buy orders stacking up here, 1 for 12. We see these aggressive buyers, but these strong breaks below. Even here we have this wick rejection, very interesting candle here. Yes, it's a red candle, but we have this rejection, we have these aggressive buyers, but the market thunders down, right? The market moves down. So what it's telling you in this region is we have aggressive buyers once again, but they don't get rewarded. So it shows you that we're at an area of supply, right? Because sellers were in control. Sellers were in control, right? And so that's sort of the way you want to approach the markets if you're going to be trading intraday,